Meet David and Kevin. Same city, same age, same paycheck. Both are 49 years old, living in Columbus, Ohio. Both earn $92,000 a year. Both have managed to save exactly $150,000 after decades of working. Both have a paid-off emergency fund, no high-interest debt, and the same family responsibilities. On paper, they're almost identical. But there's one thing they don't agree on. David believes the smartest financial move is protecting every dollar he's already earned. He's watched recessions, layoffs, market crashes, and housing bubbles. To him, safety comes first. If an investment feels risky, he'd rather earn less than lose sleep. Kevin sees the world differently. He believes money that sits still slowly disappears. Inflation doesn't ask permission. Opportunity doesn't wait. He'd rather accept short-term uncertainty if it means building more wealth over time. They both think they're making the smarter choice. They're both missing something. Because the difference between their decisions isn't just about investments. It's about psychology. A mindset built by growing up in one of the most economically unpredictable periods in modern history. And by the end of this comparison, the gap between their financial futures isn't going to come from who worked harder or who earned more. It's going to come from something almost invisible. And if you're part of Generation X, or even if you're not, you'll probably recognize pieces of yourself in both of them. Here's the rule for this comparison. No cheating. Same income, same age, same city, same starting savings. No inheritance. No lottery ticket. No magical stock picks. Just two ordinary people making ordinary decisions based on how they see money. Because feelings and math are two very different things. David decides to keep nearly all of his $150,000 inside certificates of deposit and high-yield savings accounts. He builds what's often called a safety-first portfolio. At the time he starts, his blended return averages around 4% before taxes. Interest is predictable. His balance rarely moves backward. Every month he logs in, sees a slightly bigger number, and sleeps well. Kevin keeps 6 months of expenses, about $30,000, in cash. The remaining $120,000 goes into a broadly diversified portfolio made up of low-cost U.S. and international index funds. Every month, he automatically invests another $900 from his paycheck. David also has room to save about $900 every month. But instead of investing aggressively, he adds that money to his savings accounts and CDs whenever they mature. At first glance, David's approach feels responsible. No scary headlines. No watching the market drop 20%. No wondering whether tomorrow's opening bell will erase thousands of dollars. Kevin's path feels much less comfortable. Some months his portfolio rises by several $1,000s. Other months it falls by even more. His account balance looks like a heartbeat instead of a straight line. And that's exactly why so many people never stay invested long enough to benefit. According to data published by the Federal Reserve, Generation X holds a significant share of household wealth in the United States, but they're also approaching retirement with less time to recover from major investment mistakes than younger generations. That's an important psychological pressure. As retirement gets closer, every loss feels larger, even if the long-term math hasn't changed. That's where psychology quietly takes over. Generation X grew up during events that permanently shaped the way many of them think about money. They watched the stock market crash in 1987. Many entered adulthood during the recession of the early 1990s. They lived through the dot-com collapse. Then came the financial crisis of 2008. Many saw parents lose retirement savings. Others watched neighbors lose homes. Some lost jobs themselves. When you've seen enough economic shocks, safety starts feeling like a return all by itself. And that's the first hidden difference between David and Kevin. They're not making different financial decisions. They're responding to different emotional memories. David doesn't calculate risk. He remembers it. Kevin doesn't ignore risk. He prices it differently. Now let's put actual numbers behind those emotions. After the first year, David earns roughly 4% interest on his savings. On his initial $150,000, that's about $6,000 before taxes. Assuming a combined federal and state tax rate, near 24% on interest income, he keeps roughly $4,560. Add 12 monthly contributions totaling $10,800, and his account finishes the year at approximately $165,360. Everything feels exactly as expected. No surprises. No stress. Kevin's first year looks completely different. Historically, the U.S. Stock market has averaged around 10% annually over long periods, although returns vary dramatically from year to year. Let's assume his first year happens to deliver a modest 8% return after expenses. His $120,000 investment grows by about $9,600. His $30,000 emergency fund earns roughly 4%, adding another $1,200 before taxes. Then he contributes the same $10,800 throughout the year. By year end, his total net investment assets reach roughly $171,600. Already there's a gap, about $6,000. Not life-changing. Not enough for either man to brag. But here's what's interesting. David feels like he won. His account never scared him. Kevin spent several months watching temporary declines before finishing ahead. If you asked both of them how they felt, David would probably say, "I made the safer choice." Kevin would probably say, "I trusted the process." Neither answer mentions the numbers. Both answers describe emotions. That's the trap. The financial industry often encourages people to compare returns. Psychology determines whether they actually stay long enough to earn them. Because on paper, David's account earned around $6,000 before taxes. Sounds great. Until you subtract taxes and inflation. If inflation averages about 5% over the same period, a meaningful portion of that purchasing power quietly disappears. The account balance grows, but what those dollars can actually buy doesn't grow nearly as fast. Kevin faces inflation too, but productive assets like diversified stock ownership have historically increased earnings and dividends over time, giving investors a chance to outpace rising prices across decades. Not every year, but over long periods. The funny thing is, neither man notices the real story after year one. David is celebrating stability. Kevin is learning patience. And neither realizes that the biggest differences haven't even started yet. Because the psychology that feels safest today can quietly become the most expensive habit over the next 10 years. Year 2 doesn't create headlines. That's exactly why it matters. Most financial decisions don't fail because of one catastrophic mistake. They fail because of hundreds of tiny decisions that feel harmless in the moment. A little more cash, a little less risk, one more year of waiting, one more excuse to stay on the sidelines. David continues doing exactly what he did before. Every CD that matures gets rolled into another one. Every monthly contribution of $900 goes into savings. His blended return stays close to 4% before taxes. And after paying taxes on the interest each year, his purchasing power grows much more slowly than the account balance suggests. Kevin doesn't change anything either. His automatic investments continue every month. No market timing, no predictions, no trying to guess the next recession. Just consistency. That's another psychological difference between the two. David believes good financial decisions require constant protection. Kevin believes good financial decisions require consistency. Those sound similar. They're not. By the end of year 3, David's account has grown to roughly $198,000. He's pleased. After all, he's added more than $32,000 of his own money over 3 years and earned steady interest without a single sleepless night. Kevin's portfolio tells a different story. Let's assume one of those 3 years included a 15% market decline, while the following year delivered a strong recovery. That kind of sequence isn't unusual. Markets rarely move in straight lines. His account temporarily dropped below $150,000 during the downturn. For several months, it looked like David had been right all along. Imagine logging into your account and seeing nearly $25,000 disappear. Nothing about that feels intelligent. Nothing about it feels rewarding. It's terrifying. This is where many investors quit. Research from investment firms has repeatedly shown that investor returns often trail fund returns because people buy after markets rise and sell after markets fall. The investment isn't the problem. The behavior is. Kevin almost sells. He watches financial news predicting another recession. Friends at work tell him they're moving everything into cash. Social media is full of people saying, "I told you the market was a casino." But he sticks with his automatic contributions. He buys while prices are lower. He doesn't feel brave. He feels uncomfortable. There's a difference. When the market recovers the following year, those cheaper purchases appreciate along with everything else. By the end of year 3, Kevin's portfolio reaches approximately $216,000. Now the gap is close to $18,000. Still not enough to retire on, but big enough to notice. David sees the number. Kevin sees the process. Neither fully understands why the gap exists, because the return isn't the whole story. Compounding is quietly beginning to compound itself. Now we arrive at year 5. This is where many financial stories begin to reverse. David's balance reaches approximately $233,000. Again, it feels successful. Every statement has been predictable. Every interest payment arrived on schedule. No dramatic losses. No emotional roller coaster. On paper, that's $233,000. Sounds great until you subtract everything else. Inflation has continued reducing purchasing power. Taxes have continued reducing interest income. And perhaps the biggest hidden cost of all, opportunity cost. The money that could have earned higher long-term returns never had the chance. Opportunity cost never appears on a bank statement. Nobody sends you a bill for it. That's why people ignore it. Kevin reaches year 5 with roughly $279,000 invested. The difference between the two men is now approaching $46,000. Notice something interesting. Neither one suddenly became richer overnight. The gap widened gradually, almost invisibly. That's how wealth gaps usually happen. Not through one spectacular decision, through repeated ordinary ones. Now let's talk about the number nobody likes discussing. Volatility. David loves pointing at Kevin's bad months. And he's right. Kevin's portfolio has experienced multiple declines exceeding 10%. Some years were negative. Some months were even worse. Those declines are real, but volatility isn't a permanent loss. Selling during volatility often is. That's a distinction many investors never fully appreciate. Now here's the flip point. For the first few years, David's strategy feels smarter because every month reinforces his beliefs. Safe money stays safe. Nothing surprising happens. Kevin's strategy constantly challenges his confidence. Prices rise. Prices fall. Financial news changes every day. Emotionally, David feels rewarded. Mathematically, Kevin is slowly pulling away. This is where the obvious story quietly reverses. And almost nobody notices it while it's happening. Because our brains naturally value certainty more than probability, especially after experiencing financial trauma. Generation X understands this better than almost anyone. Many remember parents clipping coupons during recessions. Many remember double-digit mortgage rates in the early 1980s. Many entered the workforce just as companies were replacing traditional pensions with 401k plans, shifting retirement responsibility from employers to workers. Security stopped being guaranteed. It became something you had to build yourself. That history explains why many Gen X investors carry larger cash balances than younger investors with similar incomes. It's understandable, but understandable doesn't always mean optimal. Now let's look at what almost nobody talks about when discussing safe money. The first hidden layer is taxes. Interest earned in most savings accounts and CDs is generally taxed as ordinary income in the year it's received. If David earns $6,500 in interest and falls into roughly a 24% combined tax bracket, more than $1,500 disappears before he spends a single dollar. Kevin pays taxes too, but much of his portfolio growth remains unrealized until shares are sold, allowing gains to continue compounding before taxes become due. That timing difference matters. The second hidden layer is inflation. Suppose inflation averages around 2.5%. A savings account earning 4% before taxes may produce only a modest real return after inflation and taxes. The statement balance grows. Purchasing power barely does. The third hidden layer is behavioral cost. This one has no receipt. Imagine seeing markets fall 20%. Many investors stop contributing. Some sell completely. Others wait years before investing again. Missing just a handful of the market's strongest recovery days has historically had an enormous impact on long-term returns. Behavior creates costs that spreadsheets rarely capture. The fourth hidden layer is cash drag. David keeps every dollar working at roughly the same conservative rate. Kevin keeps only his emergency reserve in cash. Everything else owns productive businesses through diversified index funds. That difference becomes more powerful every year because future returns begin earning returns of their own. Compounding doesn't move in a straight line. It accelerates. Think of it like rolling a snowball downhill. The first few feet don't look impressive. Then suddenly the snowball is much larger than anyone expected. Money behaves the same way, especially after the fifth year. And this is where the conversation starts getting uncomfortable. Because if all I showed you were account balances, you'd probably conclude Kevin has already won. That would be far too simple. There are costs, risks, and trade-offs hiding beneath Kevin's strategy too. Some of them are obvious. Others almost nobody mentions. And when we finally include every one of those numbers, Not just the flashy returns. The picture changes again, not completely, but enough that most people who've picked a side too early will have to rethink everything. Part 3. If I only showed you the downsides of David's strategy, I'd be doing exactly what so many investing influencers do. They make cash sound foolish. They make anyone who keeps money in the bank look financially illiterate. That's not true. Cash has a job. Safety has a value. Liquidity has a value. Sleeping well at night has a value. The problem isn't owning cash. The problem is asking cash to do a job it was never designed to do. Let's be fair to Kevin, too. His portfolio may have averaged close to 10% over long periods historically, but that average hides some brutal years. According to long-term market data, declines of 20% or more happen far more often than most investors expect. If Kevin retires during one of those periods and begins withdrawing money immediately, what's known as sequence of returns risk can permanently reduce how long his portfolio lasts. That's a real risk, not a hypothetical one. If Kevin panics during a bear market and sells after a 30% decline, his long-term advantage almost disappears. The math only works if the behavior works. So neither strategy is perfect. One sacrifices growth for certainty. The other accepts uncertainty in exchange for higher expected growth. Now let's look at the situations where David's conservative approach actually wins. Imagine Kevin loses his job during a severe recession and needs most of his investments immediately. If markets happen to be down 35% at exactly that moment, selling investments could permanently lock in those losses. David doesn't face that problem. His money is available immediately. No market timing, no forced selling. Cash wins. Here's another example. Suppose interest rates remain unusually high for several years, while stock markets produce very low returns. That has happened before. During periods like that, conservative savers can outperform expectations because guaranteed yields become surprisingly competitive. Again, cash wins. Or imagine someone plans to buy a house in the next 2 years. Kevin's portfolio could be worth considerably less the month before closing if markets fall. David's down payment stays almost exactly where he left it. Short-term goals deserve short-term money. That's one of the simplest financial rules you'll ever hear. It's also one of the most ignored. Now let's return to Kevin. His strategy wins under a completely different set of conditions. If retirement is still 15 or 20 years away, if he continues investing every month, if he ignores short-term headlines, if he owns broadly diversified, low-cost index funds instead of chasing speculative investments, history strongly suggests the probability of building substantially more wealth increases over long holding periods. Notice the word probability, not certainty. Probability, that's an important distinction. Now let's zoom all the way out. Year 10. David has continued saving faithfully. Every month, every year. His discipline deserves credit. By now, his accounts have grown to approximately $338,000. He feels confident. Friends admire how careful he's been. His balances have never experienced dramatic swings. On paper, that's $338,000. Sounds impressive. Until you subtract everything else. Interest taxes, years of inflation, and the largest invisible expense of all, the return he never earned. Kevin reaches year 10 with approximately $470,000. The gap has widened to roughly $132,000. Here's what's fascinating. David didn't make bad decisions. Kevin didn't make perfect decisions. The difference comes from where compounding was allowed to work. Cash compounds. Businesses compound faster over long periods. That's the quiet engine underneath the numbers. Now let's extend the comparison another decade. 20 years pass. Both men are now approaching 70. Both continued saving exactly the same amount every month. Neither received an inheritance. Neither started a business. Neither became a millionaire overnight through some viral investment strategy. David finishes with approximately $720,000. That's an accomplishment. Many people never reach that level of savings. He should be proud. Kevin finishes with approximately $1.28 million. The difference is now about $560,000. Not because Kevin earned more. Not because he worked harder. Not because he was luckier. Because time multiplied small percentage differences into life-changing dollar differences. That's what compounding actually looks like. It isn't exciting. Until suddenly, it is. Now here's the lever almost nobody talks about. What if Kevin increased his monthly investment by just $200? Not $2,000. Just $200. Instead of investing $900 each month, he invests $1,100. Assuming similar long-term market returns, that small increase alone could add well over $50,000 to his ending portfolio over 20 years. One small monthly decision. 6 figures. That's the power of time. Now let's ground this discussion in real data. According to the Federal Reserve's Survey of Consumer Finances, retirement assets represent one of the largest components of household wealth for Americans approaching retirement age. According to the IRS, annual contribution limits for tax-advantaged retirement accounts have steadily increased over time, allowing investors to shelter more long-term growth from current taxation. And according to the FDIC, deposits at insured banks are protected up to the legal insurance limits per depositor, per insured bank, for each ownership category. Those aren't opinions. They're simply facts. Facts don't tell you what to do. They tell you what exists. Your job is deciding how those facts fit your own situation. So what does a practical strategy actually look like? Start with step 1. Separate safety money from growth money. Build an emergency fund covering roughly 3 to 6 months of essential expenses before chasing higher returns. That way your investments aren't forced to solve short-term problems. Step 2. Automate everything. The less often you decide whether to invest, the less likely your emotions interfere. Automatic monthly investing removes hundreds of unnecessary decisions. Step 3. Review your allocation once or twice a year. Not every week, not every day. Long-term investing doesn't require constant attention. It requires consistent attention. Remember David and Kevin? They both walked away believing they had made the smart play. David believed avoiding risk was the key to protecting his future. Kevin believed accepting volatility was the price of building wealth. Neither one actually ran every number. David underestimated opportunity cost. Kevin underestimated behavioral risk. The real lesson isn't that one generation is smarter than another. Generation X developed its money habits honestly. Those habits were shaped by recessions, inflation, market crashes, disappearing pensions, and decades of economic uncertainty. Those experiences deserve respect, but past experiences don't automatically produce the best future decisions. The real trap isn't choosing savings accounts. The real trap isn't choosing index funds. The real trap is making financial decisions based on fear, headlines, nostalgia, or someone else's opinion instead of running the numbers for your own situation. Because your timeline isn't David's, your goals aren't Kevin's, and your financial plan shouldn't be copied from either one. It should be built around your own numbers. If you're wondering what happens when someone combines both strategies, keeping enough cash for security while systematically investing the rest, that's a completely different conversation. And it might be the most interesting one yet. So before you make your next financial decision, ask yourself one simple question. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.